Okay, so today's video is the 8th in our series that we've entitled Huge Options Trading Blunders. We decided to produce this series for traders who are serious about trading options for a living and badly want to succeed, but they keep getting sidetracked by pursuing strategies with huge flaws in them instead of taking the proper steps to excel and improve as an options trader. I'm the head trader of SMB Capital's options trading desk, and I can tell you from many years of experience that I've seen every one of the mistakes that we're describing in these videos, and some of them I fell for myself when I first started trading. They're real, and if you're serious about trading for a living, you really need to pay close attention to these videos so that you can avoid serious problems and unnecessary detours in your trading journey. So if you're committed to trading full-time as an options trader, then I urge you to watch this video and the rest of the videos in this series so that you don't fall by the wayside like so many aspiring traders who don't want to spend the time to learn about the actual truth and the rewards and challenges of options trading and the skills you'll need to truly succeed. We want you to take a realistic path to your trading goals, which are attainable if you're serious and willing to put in the work to succeed. Hi, I'm Seth Freuberg, and I'm the head trader of SMB Capital's options trading desk. SMB Capital is a proprietary trading firm located in Midtown Manhattan, and we provide capital for options and equity traders from all over the world, trading both remotely and in our offices here in New York City. Now, I'd like to suggest that you click on our subscribe button right now so that you don't miss any of our free trading videos that we produce for traders and investors all over the world. They're really very valuable. Okay, so today we're going to be looking at options trading blunder number 8 in our series on options misconceptions and huge mistakes that you can make in your journey towards becoming hopefully a full-time options trader. And today's lesson is one of the most frustrating lessons for new options traders because they'll often say analyze a stock or index brilliantly, properly pick the direction and magnitude of a move, time that move perfectly, and still manage to screw up the options trade they made to express their view on that particular stock. Okay, so the trade we're going to describe in this video involves buying a call. In other words, going long a call. So before we get into the lesson, let's just review the basics of what a call option is so that there's no confusion when I explain how this strategy works. So if you already know how a call option works, don't worry, this will be quick, and then we'll jump into the guts of the lesson. So what's known as a call option on a stock entitles the buyer of that option to purchase 100 shares of that stock at a certain price called the strike price of that option, regardless of what price the stock is trading at before that option expires. The buyer of a call option pays what's called a premium to the seller of the option because the seller of that option is taking the risk that the stock will go past the strike price of the option, in which case the buyer can exercise his option. But if the stock on the expiration day of the option is not beyond the strike price of the option, then the seller just pockets the premium that he was given by the buyer. He walks away completely free of any obligations. The option, in other words, expires worthless because it was never triggered. So let's say hypothetically that XYZ stock is trading at 100. So let's say that there's an options chain 30 days out from today for XYZ, and we find that the option to buy XYZ for $105 in 30 days costs 80 cents. Then that option would cost the buyer $80 because it represents the right to buy 100 shares of XYZ. And so you need to pay 100 times 80 cents to buy the option, which is $80. Now, moving out 30 days, if XYZ stock closes on the day the option expires at 105 or less, the option expires worthless, and the seller of the option just pockets the $80, and the buyer of the option just lost $80 on the transaction. However, if the stock trades up to, say, 107, then the seller is required to sell to the buyer his shares of XYZ company for $105, even though they're trading at 107. So in that case, the buyer would make a profit from having bought the call because he paid $2 less per share for a stock than it's actually worth, and he paid 80 cents for that option, so he made out on that one. So those are the basic dynamics of a call option. Okay, so with that said, options trading blunder number 8 starts out like a lot of these trading blunders, and that is with what on the surface is a very logical premise initially, and that is that buying a call is much cheaper and less risky way of executing a bullish trade than outright buying the 100 shares of that stock. In other words, you commit options trading blunder number 8 by concluding that if I think a stock is going up, I'll just buy a call. It's much cheaper. And it is true that calls are much cheaper than buying the shares. So you're probably wondering how this premise could turn into a blunder. Well, it becomes a blunder very frequently because many traders do not have a clear picture of the nature of options. And so they think that the price of a call will always go up if a stock rallies and the price of a put will always go down if the market sells off. Well, unfortunately, it's not that simple. And today, we're going to share with you a vivid example to drive this point home. So let's take a look at CMG stock, Chipotle Mexican Grill, and we'll see that back in November of 2019, it was trading up around 816. And looking at this chart, you might have been of the opinion that by early next year, CMG was going to rally and blast through its all-time high. So let's say that you went out to the options chain that was to expire in the first week of the new year on January 3rd, and you'll see that that 860 call, which is about 10 points above its all-time highs, was selling for $6.66, which means you'll have to pay $666 to have the right to buy 100 shares of CMG stock at 860 in the first week in January. Now, this could be a very attractive idea to you if you thought that CMG had a really good chance of getting to 700 by then. Let's take a look at the math on that to see why a trader might be further lured into making this trade. So if CMG makes it to 900 by January 3rd, then if he shelled out roughly $81,000 for 100 shares, then he could sell them for $90,000 on January 3rd, making a 10.2% return on his investment if he's right. But if he buys the 860 call, he'd buy the option for $666. And then on January 3rd, he'd have the right to buy them for 860 when they're trading for $900. So he could buy the shares at 860, turn around and sell them 1 second later for $900 and make a $40 per share profit immediately on 100 shares, which becomes a gain of $4,000 in total, which is over a 500% gain. The concept is obviously very attractive on the surface.
I wanted to let you know that there really are sound, viable, long-term techniques for trading options for income. And in fact, we're currently running a 2-hour free intensive workshop at the moment where we'll be teaching you 3 of those strategies that real professional options traders use, including a really simple but incredibly effective technique that some of the greatest investors in the world like Warren Buffett use all the time, plus an options trading strategy that has a statistical 80% probability of profit month in and month out, plus an option strategy that you can employ with a stock that you like where you'll make your target profit whether the stock goes up, goes nowhere, or even goes down a small percentage. So if those strategies would be of interest to you, then you should check out the free options class that we're currently running. Just go ahead and click the link that should be appearing now at the top right corner of your screen. That will open the free registration page in a new window, so don't worry, you won't lose this video. Or you can just head on over to optionsclass.com to register for this free intensive workshop. It's a rare opportunity for retail traders and investors to learn directly from Wall Street traders, but that's exactly what you'll be getting through this free online workshop. So click the link to sign up now and don't miss it.
Okay, so we've gotten ourselves into this very attractive trade where for the same expected move, we can make a 500% return instead of a measly 10%. And so we're feeling pretty good about ourselves. So we move forward to December 20th, about 3 weeks later, and lo and behold, CMG has now rallied 18 points up to 835. And so we were right. CMG's rallying. And so we're feeling pretty good about ourselves. But then we turn to the options chain to find that not only hasn't the CMG call gone up, it's actually lost 60% of its value. So the stock is up 2.2%, but the option is down 60%. And you pound your hand on your desk in frustration. I mean, your analysis was perfect and CMG rallied. And so the call should have gone up, right? I mean, calls go up when stocks rally, don't they? And the reason that you're confused is that you don't understand that options don't respond exactly like the asset from which they're derived, because there are other factors that affect an option's value. And one of them is simple to understand, and that is simply that as time goes by, an option loses value because of something called time decay. And that simply means that the longer you go, the closer you are to the options expiring, the less likely it is that the stock can get up to the strike price of your call. You see, in this example, there's only 15 days to go until we get to the expiration day, which is January 3rd. And so the option has to move up another 26 points for that option to have any value at all, right? Because if the stock is at 834 and the calls are at 860, unless the stock gets up to 860, the option has no value at all on expiration day. I mean, who's going to exercise their right to buy stock at 860 if the stock is trading at less than 860 in the open market? So that right, that call option becomes worthless on that day and it expires with no value. And so with only 15 days to go, the market is starting to devalue this option, even though CMG has rallied, because the option is running out of time to have any value. Okay, you say, well, still, we've got 15 days to go here, so let's just hang on and let's see what happens. And sure enough, CMG rallies up to 865 on expiration day, 5 points past the strike on the option, and you start high-fiving everybody and bragging that not only did you call this one right, CMG exceeded your price target by 5 points. So you're not only a technical analysis genius, you're rich, except then you turn to your options chain for CMG and you realize that you lost money on the trade. That's right, you lost money, and I want you to understand why. You see, the day that you were assigned the shares, and remember, your call entitles you to 100 of those shares, you could have flipped them immediately for $865 per share, having bought them for $860 per share. So you would have made $500 from selling those shares. But remember, you paid $666 for the shares. And so you actually lost money on the transaction, even though you were right about everything. So please don't fall for options blunder number 8. And this is not to say that buying calls is a losing proposition. In fact, we have traders on our desk who make a fortune buying calls strategically at the right time, but those traders are fully aware of the fact that the stock price must exceed the strike price of the option by at least the cost of the option itself, or you'll lose money on the transaction, as you saw in this case. With equities, it's enough to be right about direction. With options, if you don't understand them correctly and how they're priced, you can get trapped into losing money even if you got the direction, the magnitude of the direction, and the timing of the move right. You need to be educated about the nature of options pricing to be able to take full advantage of the wonderful opportunities that options do provide the professional trader in many cases.
Now, just to remind you, as I said earlier, if you enjoyed this video and learned something valuable from it and would like to learn the details of 3 real-world option strategies that professional options traders use all the time, then you should check out the free options class that we're currently running. Just go ahead and click the link that should be appearing now at the top right corner of your screen. That will open the free registration page in a new window so you won't lose this video. Don't worry. Or you can just head on over to optionsclass.com to register for this free intensive workshop. It really is a rare opportunity for retail traders and investors to learn directly from Wall Street traders, but that's exactly what you'll be getting through this free online workshop. So click the link to sign up now and don't miss it. And please don't forget to click on the subscribe button right now so you won't miss the next episode of Huge Options Trading Blunders and all the other free trading videos that we're posting constantly on our channel to help you to improve your game as an options trader.